Hi, I'm Sam Chandon, the founder of Chandon Economics and the Silverstein Chair of the Schack Institute of Real Estate at NYU. The researchers at Chandon Economics work closely with the team at Arbor to produce research into a wide range of topics and issues in the multifamily sector, including the performance of small assets and the small balance market, as well as the larger and broader multifamily markets in the United States. As we've continued to invest in expanding the suite of reports that we produce for the market, one of our important innovations has been the introduction of reporting and analysis that looks at markets by tier. The Tier 1 markets like New York or Boston or Washington, D.C. or San Francisco, and Tier 2 and Tier 3 markets, that may be markets that are smaller in scale, or markets that have historically been characterized by a lower level of liquidity. One of the important findings is that over the course of this cycle, as a larger number of lenders and investors have taken an interest in the small balance space, those Tier 2 and Tier 3 markets have been amongst the primary beneficiaries. In addition to our quarterly reports on the small balance market, one of our newest annual reports takes a look at what we refer to as the risk premium when comparing Tier 1 and Tier 3 markets in the United States. This particular chart shows that the premium associated with a Tier 3 market has actually declined over the course of this cycle. And again, in part what that reflects is improving liquidity conditions, greater engagement by both lenders and investors in relatively smaller markets, and the small balance segments of those markets in particular. One of the other important findings in our small multifamily report relates to expense ratios. What's the cost of operating assets day to day in the small multifamily space as compared to or relative to the rent revenue that these assets generate? And what we see is that across market tiers, Tier 1, Tier 2, Tier 3, the expense ratios have declined over the course of this cycle. Rents have continued to grow, rent revenue has continued to grow, but landlords, property owners, property managers have been able to contain growth in operating expenses, and that's allowed for properties to actually become more profitable in the small multifamily space. One of the questions that investors sometimes have when looking at a Tier 2 or Tier 3 market for the first time relates to the marketability of the asset, the performance of the asset, if the economy is to weaken. Our analysis is really underpinned by our expectations for what demand will look like relative to supply of small multifamily. And what we see in most markets around the country is that demand will remain very strong, and in fact, in some cases may strengthen during and in the immediate aftermath of a downturn in the U.S. economy. And that bodes well for the long-term marketability of the assets as well as their long-term fundamentals performance.